Okay, so let me just introduce or have him introduce himself, Ross, who's part of Ripple and sort of the current source of knowledge of what's happening today. My knowledge is a little out of date, so I hope together we bring together all aspects of securities and the new areas of fintech, and Ross will be the expert on that. So, Ross, why don't you just take a moment to introduce yourself?
Thanks, John, and thanks everyone for making the call. My name's Ross Edwards. I am a senior director working with global financial institutions within Ripple. Many of you may have heard of Ripple or come across Ripple. We are a digital asset infrastructure company that has existed and been working on enterprises with blockchain since about 2012. So really from the original, one of the very earliest companies focused on enterprise and financial institutional use of blockchain. Within the company, I work as part of the business development team focused on stable coins and real world asset tokenization and bringing that into our ecosystem, utilizing our open source networks where we focus on the XRP ledger, but also utilizing our enterprise products across payments, digital asset custody, and our own US dollar stablecoin, which is RLUSD. I joined Ripple in 2015, so I think very early in the stages of enterprise and financial institution adoption of digital assets and blockchain. And prior to Ripple, I worked in financial institution consulting at Accenture, where part of that I focused on custody banking, trade processing, and fund administration, as well as payments, which ultimately sort of led me across to the Ripple space. So very happy to be with you. Very excited about sharing some insights into the potentially newer area of tokenization in particular and what that looks like and how it impacts some of the core, more TradFi focused topics that John will be going through. So thank you.
Thanks, Ross. So just to highlight, will be um, today's session. And then, as I mentioned, there will be a second session on the 17th of July dealing with the back office areas of financial markets operations. But I'll send out a reminder closer to that time. So we're going to break down today's session, probably 90 minutes at most, depending if there's many questions, into three general areas. Um, the first area will be securities or products. And I think this also is relevant information for any founder because we'll talk a little bit about debt versus equity, which is something you will probably have to come to grips with very soon around your first fundraising, even if it's through a safe agreement. So I think that's some basic knowledge that every company founder needs to have. Then we'll get more into the financial markets area, look at some historic market structure, over the counter versus exchanges, physical versus digital markets, public versus private markets, and some of the key elements that makes a market successful, like liquidity and transparency. And then we'll conclude by talking about the different participants in financial markets. And I have sort of an old model, although I think it's still relevant today, where we look at the key functional areas of finance, sort of commercial banking, investment banking, investment management, and insurance. And that's what we'll close. And then you should have a good overall view of what financial markets at a very high level. And as I said, if there's any questions, just throw them into the chat as we go along. So to kick off, let's talk about securities and some of the basics that are important for everyone to know. Because as a founder, even if you're not a fintech person, you will need to raise capital. And so you need to have some basic knowledge of your options, even in more simple areas of financial instruments. And there's a couple of distinctions. One is debt versus equity. And then, as we'll see in a minute, there are subcomponents of those two key types of securities and it's very important to know the difference. So we say debt is something that's a legal promise to pay back. You can think of a bank loan, and maybe you have to repay it in various 6-month periods over a 3-year period. Maybe it's a bond that needs to be repaid in 5 years. But there is a repayment back of the issue, and that's what debt is. And it's very important to distinguish that because it has great legal consequences if you're unable to pay back. It could be the winding up of your company through being petitioned into bankruptcy. So this legal promise to pay that comes with debt is very important to understand, um, and we refer to this as repayment risk or default risk. For equity, it's a little bit different because you raise capital from an investor, just as you do raise capital from someone for debt. But the key distinction here is there is no, it's an eternal security. There is no repayment date. There's always occasional exception like term preferred shares, but in general for the equity you will be dealing with, there's no repayment. So it's very permanent capital. So on the surface, that seems much more attractive than debt does because there's no default risk. Um, Dividends are discretionary, they're not legal obligations to pay. But of course, there has to be some price for giving up those things to the investor. And the price you pay for issuing equity as opposed to debt is giving the investor some ownership in your company. So you're trading off financial risk by providing a share of the ownership and to the investor. So very significant difference between debt and equity. Most companies, when they start off, will rely heavily on raising equity because their cash flow is not certain enough to take on a debt obligation and the financial or default risk that has with it. Although maybe as you start becoming revenue generating, maybe you will start to raise money through some small bank loans or things like that. But it's assumed that an early stage company is going to rely very much on equity in its first few funding rounds. Now, as I mentioned, these two very broad security classes have lots of subdivisions in them. So debt can be a bank instrument or it could be a security. A security is something that's legally transferable or tradable. And so that when you take a loan from a bank, if you borrowed money from HSBC, you paid HSBC back. If you raised money by a bond, then you would pay back the owner of whoever held the bond when it matured, which may be a very different person from who bought it. So there is the same repayment to pay, but the difference between a security and a bank loan is securities can be traded, and therefore ownership of that debt can change greatly. This is not really relevant to corporate finance, which is intended to be our primary focus tonight. But I want to just raise this issue because I think it's really important background when we get a little bit later and Ross starts talking about cryptocurrencies and things like that. Um, Governments can issue bonds. As you know, reading the newspaper now, there's a lot of discussion about the amount of government debt out. And companies can issue bonds. So we can have what we call public sector or private sector bonds. Obviously, a government doesn't issue equity. And it used to be when I was in the market, there was a real distinction between a government bond and a corporate bond, particularly in big markets like the US market or some of the European markets, where irrespective of the rating it might have gotten by rating agencies, some people saw some superior investment um, aspect of having something held by a government that has the right to print its own money, to make its own regulations. And so there's always been in debt markets this distinction between government credit and private sector credit. And I just throw that out as something to think about because we'll return to it when we start talking about money and money versus crypto a little bit down the line. Equity, there is less variation in equity, but there is some. And certainly it's important to understand the difference between common and preferred equity because most equity you will issue will probably be common equity, even though it's privately held. Um, but if you enter into a safe agreement, a lot of safe agreements for the benefit of the investor convert not into common equity, which almost certainly the founders will be in possession of, but it may convert into preferred equity, which is equity without a maturity date, but it has a preference. So if there is a failure in the company and assets that need to be distributed, sold off to pay off the creditors as much as they can, the preferred equity holders will be paid in full, if they can be paid in full, before any of the common equity holders recover any money. So people tend to think of preferred equity as something that only exists in larger companies and for tax purposes. But given that safe agreements often associate with conversion into preferred equity, it's a distinction a founder needs to have. And I think we've always also discussed about how convertible debt is something, it's not as popular now for founders. It was quite popular about 5 or 6 years ago, which is a piece of debt that can be converted into equity at an agreed price. And this is another option that investors may want to consider. So this is about as complicated as it needs to be in the equity for a founder, but you need to know the difference between common and preferred equity. You need to know the difference between equity and debt because convertible debt sometimes comes into the arena of a founder.
Yeah, I can probably add a little bit more there, John, because I think the safe
Yeah.
and convertible debt space is very important at a sort of startup stage as well. I mean, I think you'll find in today's world, safe type constructs are used much more commonly for very early stage investment in startups. Typically, convertible debt was used in the past because it was extremely difficult, and it remains extremely difficult to get debt, unsecured debt in particular, from investors. And the convertible nature of that debt was used as a carrot, if you like, that they can share in the upside of the success of the company. The problem with convertible debt is it requires some form of valuation of the company, which when a company is at the idea and building stage is actually very difficult. And so that valuation can be wildly off the mark, either in favor or out of favor to either side of the investment. And that was seen as volatile and problematic. The SAFE agreement does not require or does not utilize a valuation of the company. What the SAFE agreement essentially says is we will have a future funding round, and any holder of the SAFE agreement will automatically participate in that funding round at a predefined discount. And so you're not placing hey, this position is potentially worth $5 million, or the company's potentially worth $5 million at this stage. You're saying we'll raise capital at a later point. The valuation will be determined then. You will get a discount in participating in that funding round. And this is, in my experience at the moment, the most common agreement that you'll see at the very early stages, pre-Series A funding of startups.
Yeah. Yeah. Very, very true. Now, something that I just want to touch upon as concepts. We're going to go through in the next couple of slides a few different sorts of areas and just provide some definitions so you have an awareness. Um, when I was starting out in the markets in the mid 80s, we had the start of the trend of securitization. And there was different types of securitization. There were putting a bunch of short-term assets like credit card receivables or things like that, and using them to collateralize a bond that was issued. Um, there have been more traditional mortgage-like instruments, which are debt, which are secured by a real estate. And so there's all sorts of securitization, which is adding some additional assets, either financial contracts or maybe physical assets, attaching them to a piece of debt, whether it be a bank loan or a bond, to provide some additional security or what they would call as a secondary source of um, payment. And securitization just exploded um, in the mid 1980s and all through the 90s and right after that. But now we have a relatively new term called digitalization. Now, when I first talked to Ross about this, because I'm a little out of date in markets, I wanted to get a really clear definition of what digitalization meant. And was it just another version of securitization, or was it somehow qualitatively different? So I'm just reposing that question to you now, Ross.
Yeah, thanks, John. I think digitalization is a rather broad umbrella term for the representation of ownership in various forms of asset in electronic form. And of course, this has been happening really since the sort of 70s in terms of centralized platforms, CSDs through to exchanges, and obviously that's very sophisticated, not just financial stack, but technology stack in the TradFi world. Where I see the next generation of digitalization is in the form of tokenization, where the ownership for a particular asset and the rights or the what's called the beneficial ownership of that asset, which is the rights to the benefits, is represented on a blockchain. Historically, and this is a fairly short history, of course, many of the larger, more established financial institutions have been looking at that on private networks, but that actually looks more like today's TradFi markets than what we're seeing more development of now, which is the use of public networks and public blockchains, and of course, these are blockchains such as the Ethereum network, such as XRP Ledger that we work on, and many others out there. So there are some similarities between tokenization between securitization and tokenization. However, they're fundamentally very different things. Both overlap in purpose, in particular to enable greater liquidity for underlying assets. However, securitization is fundamentally about legal structuring, whilst tokenization is really about the channel for ownership, asset transfers, and other uses of the underlying asset. The matter of legal ownership is critically important in tokenization, and techniques similar to securitization are commonly used. While securitization will typically involve establishing some form of special purpose vehicle, which is called an SPV, with a basket of illiquid assets, many forms of tokenization use the same approach, using an SPV, but holding a single liquid asset. And this is done because the underlying ownership of that asset cannot be represented in tokenized form, either for regulatory purposes or because of the capabilities of the primary issuer. So if you look at, for instance, probably the most liquid, common, simplest asset in the world, which is effectively T-bills, which is short-term debt against the US government. The US government is not managing ownership of any T-bills on a blockchain. So what tokenization platforms and asset managers are doing is holding those T-bills in special purpose vehicles and essentially managing the ownership of those special purpose vehicles on chain. So you can see the mechanics of securitization and tokenization significantly overlap, but the actual fundamental enablement that they're doing, legal structuring versus the channel of ownership is fundamentally different. So again, huge, significant overlap between these concepts. The matter of legal ownership, particularly from an investor side, is critically important. It does impact risk. It does impact the use cases for these assets. However, tokenization is really about enabling more use, easier transfer, easier proof of ownership, and other mechanisms rather than the underlying legal structuring.
So I'm going to come back to that at the end of this slide with a follow-up question. But first, I just want to introduce derivatives from the older-fashioned security perspective sort of way. A derivative, it could be an option, it could be a future or something like that, is a financial contract that mimics the price movements, sometimes perfectly, sometimes not perfectly, of some other financial asset. So, for example, if you trade an exchange, you can buy options to buy and sell that exchange or stocks on it. So you're trading in some, and it was good that Ross introduced the term sort of like the contract and the underlying. So if your underlying is the stock of, say, Apple, and you buy an option to purchase or to sell Apple, that's a derivative related to an Apple equity, the underlying concept. And there's all sorts of derivatives um, out in the market. Forwards and futures is one major category. Options is the other category. And I'm not going to go into a lot of detail about these, except ask that one follow-up question to Ross. Um, Given what you said about tokenization, does that make tokenization, relatively speaking, closer to being a derivative than being a securitization?
I don't, in my view, I don't see it aligned closely to derivatives. There is a definitely a linkage and similarity there. But really, tokenization is just about the thread from, as an investor, how do I prove or utilize in some form the ownership I have in this asset? So it's really about what I would call channel. How do I see my asset? How do I use my asset? Rather than derivatives are really about, um, you know, typically some form of financial structuring on top of that asset. So, you can think about that as three different pieces sort of moving around and to think about. Securitization is really a matter of legal structuring. Derivatives is really a matter of financial structuring. And tokenization at its core is really about the channel of ownership and the relationship between investor and issuer. So that's sort of how I think about it. Of course, there's been a lot of development in derivatives in the tokenization space, in the blockchain space, in many projects that have created what's called synthetics on top of blockchain. So essentially, I over collateralize in a particular asset. I receive some form of wrapped or synthetic form of an asset that will track the price of the underlying. So as an example, I may lock up stablecoin, say $2 million worth of stablecoin, and I receive synthetics in the form of $1 million worth of what's a good example?
Your own.
BHP shares, right? I am Australian, so I typically go with the Australian market. As the BHP share price goes up, the value of that will increase. As it goes down, it will decrease, backed by the underlying collateral of the US dollars. So the fact is that there are no BHP shares ever created or ever available. When I exit that position, I exit using the collateralized position in US dollars. So these are interesting developments. The only other thing I would say is, from a financial markets perspective, derivatives are critically important to manage risk and price discovery in sophisticated markets. I obviously work in the cryptocurrency space as well. So if we look at Bitcoin, ETH, XRP, and there's within our industry, there's always a lot of noise around the establishment of derivatives markets for these assets. And the reason is that it enables much more sophisticated players to build out products and services and investment approaches in these assets. So it makes a huge difference being able to manage risk, which is critically important for institutional investors, being able to establish price discovery, and many other mechanisms that are important to more sophisticated investors. So I would not underestimate the importance of derivatives to financial markets.
Well, that takes us into another one slide concept about what is money. And we know money as it's often referred to today as fiat currency because US dollar or other currencies are not backed by gold anymore. They're just things issued, printed by the government as a legal promise to pay wherever that currency is existed, which is almost always the home country of that. Um, and so again, just sort of following up, although it's slightly a different tact here, I want to look at the difference between cryptocurrency, which is sort of like a private sector currency, and government fiat money. Um, because if you took a traditional economics course about what is money, it's a medium of exchange, it's a measure of value, it's a store of value. So cryptocurrency to the uninitiated sounds sort of like a currency, a money. So is it fair to say cryptocurrencies are just private sector money, whereas the US dollar is a government issued money? Is that a correct comparison, Ross?
I think to a degree, John, I think when I think about cryptocurrency, I really think about two very different classifications. One being stable coins, and the other being um, true native cryptocurrencies like the Bitcoins, ETH, XRP, and many others in the world. If you look at stable coins, effectively, particularly fiat-backed stable coins, which most large stable coins are in some form, um, they're very much sort of like commercial bank money, just with a different structure behind it that may increase risk. It may have a different risk profile, but the actual mechanics are very similar to a bank deposit. So as an example, Ripple, we issue ROUSD. We manage the backing of that in a company called Standard Custody, which is regulated by NYDFS. It's prudentially regulated. So they ensure that there is an over collateralized position in a certain set of assets that are typically highly liquid cash-like assets. The difference between a true operating bank and standard custody is that standard custody generally has to have full backing in cash or cash-like assets, where a bank will have a much more diverse set of assets that they can manage that money in particular, private sector loans, etc. And that's what creates the sort of reserve banking structure. So I think stable coins are fairly well recognized. However, you need the understanding of there is risk or exposure to whoever the issuer is and their fundamental regulatory and risk management systems. If standard custody was to not be operated properly, then that backing fiat may not exist, and that would be a huge problem in the event of any catastrophic failure. Of course, because we're regulated or prudentially regulated by NYDFS, we will be in trouble off NYDFS if there are any problems in that space first, and I think that gives everyone a lot of comfort. Now, if I switch over to the true cryptocurrency space, Bitcoin, ETH, XRP, these are fundamentally different. I think the risk stack is hugely different to any form of fiat money. So where fiat money has risks, you can think of a whole stack of risks across different forms of money. Operational or systematic risk, which is can I access the money when I need it? Market risk, is that is that money going to be worth more or less, in the future? Um, and credit risk. Can I trust the person on the other side of this to, effectively pay me when cryptocurrencies such as Bitcoin, ETH, and XRP have um, proven fixed supply mechanisms. So the supply is based on an algorithm that can be trusted because it can be technically proven. And so the actual sort of issuance risk and credit risk is effectively eliminated. No one can come and produce a billion more Bitcoin tomorrow. It's not possible. Whereas with sovereign funds, or sorry, fiat money, obviously we've seen quantitative easing, etc. The issuer, being typically sovereign governments or their central banks, can come out and effectively print more money and increase the supply, which of course affects the financial value of that cash. On the flip side, sovereigns manage the market value of their currency very carefully. We've seen the effects of inflation and what governments and their monetary policy vehicles take when inflation is too high, right? They manage the economy based on that. Cryptocurrencies, on the other hand, are free market, valued assets. No one's increasing or decreasing supply to manage inflation. So the market risk, at least from a perceptive perspective, and it's true at the, certainly to date, are much more volatile on the market risk side. And that, definitely affects their ability to act as money. I think that, most, particularly, traditional financial institution people would say that cryptocurrencies in that form are not typically a great medium of exchange because they're too volatile. They're not a great measure of value because, again, they're too volatile. That value, how much Bitcoins is this house worth, changes fairly wildly relative to relative to fiat money. So in the regulated securities market, I think stable coins as well as all fiat type monies is much more relevant to the discussion than cryptocurrencies. But of course, as with everything, there's a bit of a spectrum of involvement across these. So I'm more than happy to provide any more information across that. But that's some of the ways that I think about this.
Okay. And if you have any questions as we're going along, just type them in the chat, and I'll take a look at them anytime that Ross is speaking. So, having provided that introduction about securities, and you can see now with all of the new initiatives in the market, of the blockchain, with the cryptocurrencies, with the digital assets, financial markets are so many times greater in variety of instruments than when I was involved with 21 plus years ago. It's really exploding, and I think it's fair to say that the new markets, the stable coins, the cryptocurrencies, the digital assets are just expanding the financial markets as opposed to replacing. I guess there may be some cannibalization over time as digital markets become more expanding, but I think it's still relevant to also understand securities markets because they're probably going to be around also for quite a long time as well. So let's turn our look at markets and market structures and give some basic background. There's some reasons here, even if you're not a financial markets, if you're not focused on financial markets, but you're a founder, there are one or two points here for early stage companies to consider as well. But just as a little bit of background, in the olden days of securities markets, which were debt and equity, before we had all of these stable coins, cryptocurrencies, and digital assets, markets typically came in two forms. They were either exchange based, which was mostly equity markets or commodity markets, or they were what we called OTC, over the counter, which is direct trading between two particular participants without going through some central counterparty, i.e. an exchange. So we had over-the-counter markets, which were typically banking and bond markets, and we had exchange markets, which were typically for stock markets and commodity markets. Another distinction, and this was a transition that happened a long time ago. Once upon a time, you might have seen, I guess, what are now old movies about actual physical exchanges, people trading, shouting the pit in Chicago, and all of these things, and writing tickets out and exchanging them, hopefully not losing them. And then we had um, electronic trading, which is not the digital trading is today, because electronic trading was just getting rid of the paper, but still all of the transactions went through that particular exchange. Whereas I think that digital trading, and I will pass this over to Ross so I don't say anything incorrect, is going beyond the single exchange and connecting everything sort of globally, because we have a global network right now. So I know in banking we had physical securities, and then we had straight through processing, which was just the internal automation of all of the processes. And it wasn't until after the internet that was established that we could trade over the internet. So I'm guessing digital trading is electronic trading, but with no boundaries, or certainly not constrained to any one particular exchange. What would you say in that regard, Ross?
Yeah, and I know Elvin sent through a question. I think we'll pick that up when we come to the questions section. So in terms of digital trading, yeah, again, similar to some of my other answers, there is a sort of TradFi space of digital trading, particularly in the OTC type markets. However, a lot of the focus in the tokenization and blockchain space is, of course, on the concept of decentralized exchanges. Now, firstly, when we think about an exchange and the mechanism to exchange, I really think about three different processes: price discovery, match, which is knowing at what price you can transact; matching, which is creating the obligation for you to exchange assets. So matching is really that agreement that I will, or I have an obligation to transfer these equity shares or debt instruments and receive some other form of compensation, and vice versa on the other side. So that's matching. And that's where the legal definition of sort of exchange sits. And then you've got the settlement, where the underlying ownership records are actually updated. And all of these things are equally relevant. And all of these things in different forms can be made electronic and indeed actual digital. Now, what we see a lot of in the blockchain and tokenization space is price discovery and matching performed off-chain in centralized venues, where there are responsible parties for doing that, but the settlement obviously needs to be played onto the blockchain to affect that movement of the tokenized form of the asset. In the future, we're certainly looking at the potential to use what's called decentralized exchanges. These are exchanges that are wholly implemented on decentralized networks or blockchains that operate without any individual operator to provide price discovery, matching, and settlement as a single atomic action. This is extremely different to TradFi markets. And it's actually, one of the challenges is it's very hard for regulators to assess, because the typical approach of a regulator is, I have some responsible party that I regulate who is responsible for ensuring the rules in this exchange. They're responsible for ensuring there's no front running. They're responsible to ensure that there is reasonable risk of or reasonable mitigation of settlement risk, where parties do not follow through on their obligations from the matching process. that isn't available in a decentralized exchange space. And that's why this is extremely nascent in the regulated security space at the moment. But I think we're going to increasingly see interest and adoption in that. And that does fundamentally change the way that exchanges work. And it does fundamentally change the capabilities of some of these assets. The separation of price discovery, matching, and settlement can produce risk, can produce challenges in utilizing these assets in different ways. And so we're going to see, tokenization truly transform that space. Of course, when you look at fundraising in particular, for startups, which I think is one of the main areas of interest here, it's much more done in the sort of OTC, private equity and private debt type markets. These we're seeing some interest in the tokenization space, but it's still fairly nascent today, or limited today.
Okay, so introduce the area of private capital. I think I sort of skipped over one. Just talk about public versus private, distinguish between them. When we talk about, and let's use equity capital because that's the simplest and most relevant example for this audience. When we talk about public equity, we're talking about something registered on an exchange, which therefore there is an oversight and compliance of that security of reporting requirement through an exchange or through some central clearing party. And that's sort of the key difference between public and private markets, where in private markets there's a transaction between maybe just two parties, but certainly two sides, and there's no public disclosure of financial results, important events as you have in public markets. So, the key distinction is in public markets, there's the extra time, cost of reporting and disclosure, which is, of course, very important for investors to make informed decisions. Whereas in private capital markets, there's much more limited disclosure only to the people who are interested in that particular transaction and only to the extent of the information that they're requiring. So, if you as a founder do your first fundraising in whatever way, shape, or form, that is not going to be, or it's highly unlikely unless you choose to, that is not going to be disclosed, and that will remain, um, private as it would expect it would be. So, turning to the venture capital market, and I'm going to make a distinction between two terms which are sometimes interchanged: venture capital and private equity. For my definition, venture capital is the private equity that goes to very early stage companies to allow them to commercialize or to grow. Private equity, my definition is um, private capital um, frequently being used to take a public company private. So it's often much larger, and it's often to take what was a public company into private. And that's the difference I use. Different people have different definitions for particularly private equity. I think there's pretty common agreement on what the definition of venture capital is. But as early stage founders, as you approach the market for the first time, you're dealing with venture capital, even though in a very general way you can say venture capital is a private source of equity. Just a little bit of distinction about um, terminology. Um, just two other things to throw out, some terminology here, just so we're familiar with it. We'll be talking when we talk about institutions later, banks. Um, what is shadow banking? Um, that is providing bank-like services by financial institutions that are not regulated, sort of like unregulated um, banks. So let me ask a question, Ross, on this. How do we classify the major players like Ripple? Are you a bank? Are you a shadow bank? Are you a technology company? How what label does Ripple follow under?
Um, so Ripple was very much founded and started as a technology company. So we spent many years providing technology services, and in particular, not operating in services that are typically require financial regulations. You know, most of our history, we've been providing payment services. Obviously, we do a lot of other work across the blockchain and digital asset space, but these were all providing technology solutions to, typically regulated financial institutions. When we say shadow banking here, for instance, this is not murky. It's just financial institutions that are regulated that aren't banks providing different forms of services. We have found, many years ago that not providing regulated services actually limits our ability to deliver value to our customers, most importantly, and to own end-to-end solutions in this space. So we'd be dependent on other parties for certain links in the chain, and we know as business operators that that impacts the ability to deliver sustainable value to our customers. So we have gone into the licensing space. I think we hold in the order of 60 licenses globally. The vast majority of those are across the US. I think there's 44 across the US. That includes the BIT license in New York, as well as standard custody's bank charter license in NYDFS, but also includes a vast array of MTL, so money transfer license, as well as digital token licenses, etc. So as an example, in Singapore, we hold an MPT license. We have an outstanding um, application for a major payment institution license in Singapore. So increasingly, we're providing regulated services. We're obviously not a bank, outside of the banking charter, which is a more complex construct in New York. But we do provide services in this space. So I'd certainly say, we are a provider of financial services who are not a bank, so can fit into that overall definition.
Okay, and just one slide that isn't typically about markets, but I thought this was a good place to introduce it. Um, we've talked about liquidity, and Ross has talked about how important that is to be able to transact quickly, manage risk, and all of these things here. So, how does liquidity manifest itself to a founder? Well, when we talk in 2 weeks about the funding session, we'll talk about venture capital firms, and we'll mention how some will only invest in you for a fixed period of time. They want to exit at some point in time, maybe 5 years, maybe 7 years, maybe 12 years, or something like that. So, as we said, your offering of equity, your venture capital raise is private equity. It's hugely illiquid. If the investor decides a year after they don't like it, or maybe they need the money to do something else, they just can't go to the market and sell it. It's highly illiquid, and they will demand some sort of premium for that illiquidity. But they won't want something that's 100% illiquid. They want to have the option to exit at some point in time, to sell their investment. If you've just raised a seed round, your very first round, chances are your next round is going to be another private equity, maybe venture capital investors. You go seed, you go round A, some go up to round B, round C, round D, and so there is many fundings done in the private capital space, because even though equity is meant to be a perpetual investment, the people who purchase equity, I'm sorry, the investors don't want to hold it forever. They want the ability to exit because they want to focus on the capital appreciation in the early days. And so understanding the concept of liquidity gives you an understanding of why investors that you may be negotiating with in the near term want an exit, and how you can think about it from their perspective in the negotiation to try to get the best terms for yourself.
It's probably worth mentioning, John, for those who are unfamiliar with the sort of private equity space, as companies reach fairly well established sort of private placement or private equity positions, seed A, or round A, B, C, etc. There are still various marketplaces and infrastructure available for transacting, so selling and buying in the open market those assets. Platforms such as NPM, which is Nasdaq Private Markets, EquityZen, Forge Global. These are all US bodies. I'm sure there are overseas ones as well, but they're just the ones that I'm familiar with. Effectively list private equity and enable trading. It's obviously has a lot more friction than public markets. So as an example, for pretty much all cases for private equity, the underlying company has some control of that transfer. For instance, can revoke that transfer or need to approve any new investors, etc. And to give you some idea, typically the fees these platforms are going to be charging is in the order of 5%, which from an equity markets perspective is beyond substantial, as you would know if you've traded in the public market, where you might be paying a broker tens of bips, as an example. So these avenues are available and worth looking at as your startup becomes more established and as you need liquidity in your underlying equity, and that does provide great value, as John's pointed out, for investors.
Yeah, I mean, that's a good point. And I'll just add two comments. Um, I don't think secondary markets, all other things being equal, are nearly as established in Asia as they are in America. America, when it comes to capital markets and trading, is far ahead of, I think, everywhere else. But the one thing I work with a company, a venture capital fund, and I won't mention their name because it's not meant to be a plug, but they have a second business line. They have an online marketplace for companies either that they've invested in or companies that they've not invested in but want to help the company get some profile, introduce them to other private capital investors. And it's not a transaction platform as Ross was um, suggesting. This is more a marketing platform. It's to give exposure to your name, to get more broad dissemination through the internet of you're looking to raise capital, what your business is about. It's more a promotional platform, which I guess for much more illiquid markets that don't have these developed secondary markets is sort of the natural first baby step in that direction. But it's something to think about because I work with this VC firm, and we're happy to put people on. So when you come to raising capital, if you would like a little bit of marketing promotion, not an actual transaction platform, that might be another way of just getting the message out. It's not the trading platform that Ross was implying to, but it's creating awareness. It's giving you the possibility to attract other investors, which I guess is a very simplistic way of saying making market. Okay, so on to our final stage. We're sort of on time. It's 2 minutes after 8. This is where I expected to be starting the third. This is a little bit longer. We get into a little bit more detail about the various participants, focusing more at the institutional level as opposed to the retail level. And I just want to fly through the first few slides to give a bit of background and terminology and a frame of reference to how we look at participants at the institutional level. This is just one of many characterization of financial markets. This is the one the Bank of Canada used for many decades. It was called their four pillars approach to regulation. And they wanted to keep different financial activities separate and regulated by separate government entities. And so they divided the finance industry. This was post-World War. This was in the 1950s. They were creating this model, the four pillars. And there was banks, the commercial banks as we know them, the ones that take deposits and make bank loans. There were the investment dealers, investment banks that underwrite securities, either debt or equity, and sell them into the market, either institutional or retail investors. There were the investment companies. Contrary to the investment dealers, these investment companies were hired by investors to help them manage their investments. They were sort of became the counterparty between investors and the investment dealers or the market overall. But they became very large, and investment companies these days, like the BlackRocks, the Fidelities, and all of those, these are very large companies. And then the fourth pillar, which some people talk about as sort of qualitatively different to the others, was the insurance company, and that there's a different definition of risk we use there. So this is the framework that we use, a simplistic way to break down the financial area. So I've put a little bit of definition on each of these. I'll make a few points that might be relevant to a founder when they're looking at different sources of money, and maybe at some point in time you might want to take a bank loan. A bank and a bank loan is very different from a security, because when a bank raises money from a depositor and then lends money to you, the startup company, those are two totally separate contracts which are managed differently. So, if you can't pay your money, that has no implication for the bank or to pay the depositor. Contrast that with investment dealers and a bond, a debt obligation. Um, the investor, maybe through an investment bank, buys the bond of the company, but the bond of the company has to be repaid by the company, sort of like the one who got the bank loan. It's not the responsibility of the financial underwriter and the intermediary to make two separate contracts and to guarantee them both. And that's an important distinction for both an investor and a borrower. So if you come to the point where you issue um, a, a bond or something like that, you are using perhaps an investment bank to issue the bond, but you take on a direct relationship with the investor, not with the investment company. Whereas if you borrow money from a bank, you're always just going to be dealing with that bank one on one, and you don't concern yourself about how the banks fund itself. This difference is really more relevant for investors, but I just wanted to make that comparison for founders who may be taking on a bank loan in the foreseeable future. The third one is the investment companies. As markets became very large, complicated, we've talked about securities, securitization, digitalization, derivatives, stable coins, crypto. This has become a very complex market for people to make investment decisions. And I'm sure you all know of lots of very well educated people, but they're lawyers, they're in technology, they don't know finance and financial markets. And so there's a very big need in the market to provide financial services. And of course, providing these financial services also creates a lot of opportunities in the technology space to provide some new SaaS or otherwise solutions to financial markets. Of many of the so-called fintechs that I've dealt with in the last year are more like technology providers to the financial markets to solve some sort of problem in the market, and they often end up becoming part of a larger company as opposed to being a standalone business. And then we've talked about investment funds. This is something, I mean, Ross was talking about counterparty risk, and custody and some other areas earlier on in the discussion. The second session in July will be focusing on financial market operations, the transaction, the settlement, the reconciliation, and the custody. So I don't want to go into that into a lot of depth here, other than to say that there has to be some custodian that holds your security for the benefit of the investors, and the communication between the investors and the issuers, you, a startup, um, to make sure that security and those communications are secure and maintained. So I'm going to, on this financial markets operations note, ask Ross a question, even though I said we were going to stay in the front market. But you've been in both. So how different is the world of custody to your business than it is to traditional securities trading?
Yeah, so I mean, I've worked across both areas, and custody at a base fundamental level is really about the safekeeping of your assets and accessibility to those assets. So how do you know you have them? How do you know you can use them? That is through, that's the services provided by your custodian, and then they provide a bunch of value-added services on top of that, both financial as well as regulatory in nature. Um, it's important to understand when we start to look at digital assets, there are two types of layers. The first is custody technology, and this is the technology that provides the ability to manage your custody, either in a self-custody way or the actual fundamental technology that custodians use, which is what I'll get to in a minute. Um, Custody technology for digital assets is vastly different than the systems and technologies that traditional custodians use. Um, and it is fairly much more focused on the use of cryptographic keys in different forms and the different approaches used for that because of the nature of blockchain records and tokenization and crypto. It's like a bearer type asset where the proof of ownership is managed through having a private key. That is substantially different than the ownership model for the TradFi space that the custodians use, where effectively you have a name, listed on a registry held by some regulated authority. And so the technology is vastly different, and the technology is where Ripple provides products and services in the custody space. What we don't do is we don't provide digital asset custody as a service. So we do not hold assets on behalf of customers. We provide customers with technology that enables them to hold it themselves. And we provide custodians, the digital asset custodians in particular, such as some examples would be Zodia, which is a digital asset custodian, fairly familiar in Southeast Asia. Another one is HSBC, Security Services, which is doing not just traditional custody, but digital asset custody. There is a very high similarity between digital asset custody services and TradFi custody services. And that's why we're starting to see the build out of services in this space by the traditional custodians, such as HSBC that I mentioned, and many others that we closely work with. So I'd say technology is vastly different. The actual services at their core are pretty similar.
In 5 years' time, the big six custodians in your markets, will they eventually become the same big six that we have in traditional markets, the State Streets and all of these?
That's a good question. I think the jury's probably still out on that. Obviously, I think it's very early days. I think traditional custody people would probably say that that's the direction it's going to tend towards. But of course, if you're investing in new age digital asset custody providers like Zodia that I mentioned, there are others out there. BitGo is another example. You obviously see a place in the market for other specialist providers. So I don't know what the answer to that is, John. Unfortunately, the crystal ball gazing's difficult in that space. But I think another similar interesting question is TradFi custody has typically been a race to the bottom. it's not a high revenue, um, highly monetizable business. It's typically needs to be bundled into a broader services, sorry, broader, bigger business that provides value added services and bundling of services. A similar question is, will digital asset custody head that way as well, where it's essentially just an add-on service that's effectively for free and you're making money off other services? And I think that that's an interesting question going forward as well. But we're going to see both of those questions play out in the next 5 to 10 years, I would suspect.
I mean, the big trend of the 90s was the consolidation in the financial sector. The investment, all of the front office financial institutions became financial supermarkets, and there was the consolidation of the back office was a little bit slower because they tended to be more national, highly regulated, or associated with an exchange, and that. But it was a real consolidation. So if history repeats itself, which sometimes it does and sometimes it doesn't, because the digital asset market is so new, just using the example you're talking about, it sounds like there's going to be some consolidation coming in the market sooner rather than later.
I would expect definitely some form of, over the long run, there will definitely will be consolidation. It's a matter of where it consolidates to, I think. And obviously, the big players are investing in this space. They have the resources, they have the existing trust. So I guess there would be a lot of money backing them. But absolutely, there will be consolidation in some form.
Okay, we could probably talk about that, but I just wanted to come back to that question or that statement I made that when we first looked at the four pillars, we said that the insurance is sometimes looked at as a slightly different aspect of financial markets. Banks, investment banks, investment managers, they're sort of all dealing with financial risk and securities. But when we look at insurance companies, we're talking about conceptually a different type of risk. Risk in financial markets is uncertainty. It's about, my forecast of the stock I bought, what can I sell it for in 1 year? It could be higher, it could be lower. That variance about my expected value is what we refer to as financial risk. But insurance risks relates to the occurrence of um, an adverse event. Will I crash my car? Will there be a hurricane that damages my house this spring in Florida, or some sort of adverse event that we want to buy some protection against, a premium? We want an option. We want an option to call money if this adverse event happens. And I don't want to go into that any deeper now because I don't think it's relevant at this point, particularly for the audience to be talking a lot about options and things like that. But I just wanted to make that distinction that that is the reason why sometimes in some markets, and it was true in a lot of markets, insurance was sort of kept separate from the financial markets as a general. That was true in Europe. It was true in New York. They were always keeping insurance as sort of a different pillar. So we're coming up to 8:17. Um, we're coming, but the point before we leave this section is financial industry is huge. Um, the usage of technology in the financial industry is huge. And there is also, however, a need for a lot of other services as a part of that. So, people who are investment consultants who can provide financial advice to retail investors or maybe even institutional investors, they can make a small and profitable business without being a big firm. Actuaries legal persons, accountants, auditors, and of course, all sorts of IT consultants. The financial industry being built around intangible assets is probably one of the greatest users of technology in any industry sector. So that brings with it a whole host of other demands, not just the basic trading of financial or digital instruments. So in the past, when we've run the fintech sector, 4 out of 5 companies were actually sort of SaaS companies who were targeting the financial industry to provide a service that would help their core business. So just to close off, before we get to any questions, and the one that I understand is in the chat, I want to close off with just 2 thoughts. And this is very relevant, I believe, to the founders. So post the financial crisis, sort of 2007, 2008, America and most others followed to a greater or lesser extent. We had quantitative easing, which in simple terms meant just a massive decrease in interest rates, a massive increase in money in the market. Now, I'm going to give some personal opinions that you may or may not agree with. But to me, that led to a lot of bad financial decisions, over borrowing of debt, valuations beyond what they would have been in a traditional time, and just an explosion of money chasing assets. It was as we used to say when we used to study bubbles, this was the buy anything bubble, because money was just flowing out so quickly. Now that's all come to an end. So quantitative easing is no more. So that means 2 things. There's not as much cash, so there is not as much cash available to the venture capital industry. And also, a lot of these deals made in quantitative easing, now that we've got a more normal environment, if we can say that, are underwater. And so there's a lot of workouts of previous deals. So relative to even just 6 or 8 years ago, this is a much, much tougher market to raise capital for startup companies. And I don't think that is going to get really materially better before the end of the decade. This has an implication for companies because remember, when you start your business, um, unless you have something that you think can be a standalone business, like maybe you're an IT SaaS firm providing a specific service to financial institutions, then another way for you to exit is to find a corporate. Maybe initially your first customer, maybe then a partner, maybe then a corporate venture capital firm, or maybe later an acquisition. So my personal view, it's just personal view, is that going forward for founders, you need to spend more attention, relatively more attention, on what sort of partnerships, what sort of corporate customers, what sort of corporate big brothers, what sort of corporate venture capitals you can use to help develop your business, and not rely as much on in financial investors as it was the case in quantitative easing, because the easy money is over, and finding a big company, particularly if you've got a very narrow service or product that naturally fits as a part of a bigger company, I think that is a more likely road to go in these more difficult funding environments. Ross, any sort of thoughts on where you find funding if you were starting out Web3 blockchain or developing that?
As you said, I think the traditional routes certainly, generally, funding starts with sort of angel investors, all the way back to friends and family, those sort of pieces. And there are various groups to meet people who are interested in that sort of investment side. When I look at Australia, for instance, we have things such as the Australia DeFi sort of community group where you can meet potential investors across that. And if you're in Web3, I mean, you should always be, of course, looking at sort of grants from different players in the market. So as an example, we have a grants program for building on top of XRPL. And that grants program runs from, incentive-based sort of milestones, which are simple grants. They're not debt or equity, but can lead to sort of equity investment as scaling, is proven. So definitely, and obviously there are many other active players, particularly in the layer one blockchain space, that do these types of investments all the way to equity. I guess getting to sort of Elvin's question, which is more directed towards tokenization, we've seen some forms of arbitrage in the form of what's called initial coin offerings, ICOs, and they've obviously had a lot of regulatory trouble. And to be honest, they've had a lot of demand problems. So if we look back in the sort of 2018 type period, these were what I would call all the rage. I think many of them ended up in legal and regulatory problems. Many of them ended up being scams, for lack of a better term. And I think, they lost the trust of investors ultimately. So it's a very, very niche, small market for those reasons now. When we look at what I would call proper tokenization, looking at real world assets and in particular financial assets, these are regulated instruments. There's not really any shortcut. It's not about issuing equity through a token that wouldn't have been legal outside of tokenization. I do see some interest and some good projects in the private equity space, but they're typically for well-established, high asset value type businesses. So as an example, we have one project where it's private equity in data centers that are being built. So it's not private equity for the sort of startup end of the scale. These are for big infrastructure projects that are well established. So my short answer would be that there's not really any shortcuts in the tokenization space, and I wouldn't say you can issue securities through tokenization where there's regulatory blockers outside of tokenization. You still need to comply, the organizations involved still need to apply with all securities laws. And yes, tokenization can be used as a tool and can improve things, but not outside the boundaries that the regulatory rules today require you to follow.
Let's look at the other side, the corporate M&A side. Now, yours is a much younger industry than the traditional securities markets. There's many smaller players as opposed to the more consolidated, concentrated securities firms. So, are firms like Ripple or your competitors or what, are they more actively seeking out new founders, new ideas? Is your firm a more natural buyer of outsourced R&D starts than big Merrill Lynch or the State Street because your industry is at such a younger age?
I mean, I don't know about bigger. I think we're certainly another option, and really there are three different areas. It's sort of traditional source of capital space, whether it's venture capital, banks, etc. There are specialist VCs in the Web3 space, all the way to the likes of the heavy tech VCs such as Andreessen Horowitz, uh, Google Ventures, both of which are early investors in Ripple, as an example, really are looking at this space. When I look at Ripple, and we have obviously a corporate development arm. I don't know, you may have seen some of the things we've done, such as we purchased Medico, which really is the core of our Ripple custody offering. We purchased a prime broker called Hidden Road. Well, that deal is still sort of in progress or execution, as well as making myriads of investments in companies. But we only do strategic investments. We do not do investments for the purpose of making money out of that investment. So where we see synergies with our products and services and with building the XRP Ledger sort of ecosystem, that's where we prioritize our investments, and certainly that is a good avenue in some cases. We do that through through multiple different arms. Through, as I said, the grants is more designed for the sort of startup, early stage sort of type of arrangements, and then our business development and corporate development more look at well-established businesses. But yeah, it's definitely another option to think about.
Okay. So just closing off, I want to just make a brief comment here and then get your perspective on this in your industry. So when I in the early 80s, we saw a fundamental change in the market of investors. Actually, it was before that. It was in the early 1970s. We had something called the ERISA, ERISA, legislation come into America. The creation, the requirement for a lot of larger corporations to create pension funds for their employees. And this started the boom in institutional pension funds, as opposed to prior to that in the 60s and the 50s, where stocks and bonds were just bought by rich people as individual investments, sort of like what we refer to as the high net worth people these days. Institutional funds have become huge. We all know what the size of of Blackstone and all of these companies are. But of course, then there's also high net worth individuals who are investing um, just for a particular family or something like that. So to close us off, Ross, can you make any generalization about the investor world for digitalization? Is it being dominated by institutions, or is there a big retail network, or is it split? What's the investment community for your world?
Yeah, I think this is a very important point, John. So first of all, as business founders who are potentially raising capital, um, or if you're otherwise acting in financial markets, you first need to understand that there is huge differences between operating in the institutional space versus the retail space. The regulations are significantly different. And in particular, if you look at the concerns of consumer protection, and you're in Hong Kong as an example, in working with HKMA, their primary purpose in a lot of their regulatory direction is focused at consumer protection of the retail market. So there are a lot more possibilities, and you're able to move a lot faster in providing institutional solutions out to the market. In many cases, when you look at early fundraising, you're going to be limited to institutional and what's called sort of professional, or what's other terms for it, sophisticated investors
Yes, sir.
that meet certain regulatory criteria, who regulators deem to have the knowledge to assess the risks appropriately in these investments, as opposed to the true retail market where additional disclosure and regulatory controls need to be on place. Now, there is a sort of fairy tale view somewhat of tokenization and blockchain that, it's all going to magically enable everything for retail end of the market. And I think there are products and services beyond crypto, which is a huge retail asset class, by the way, beyond crypto that will apply to the retail market. But make no mistake, I think the big plays in looking at that are in institutional money. Yeah, that's the reality of it. That's where the bulk of it's going to come from. There's not going to be, in my mind, this this movement of investment and funds back to the retail market. The institution is still going to be the heavyweight. If you look at the biggest tokenized assets in the world, so if you take BIDL, which I think is by far and above the biggest market cap form of tokenized asset on public blockchain anyway, the vast, well, it's only offered to US institutional and sophisticated investors. So the biggest assets already on the blockchain are limited to the sort of institutional funds. What does happen is we get some repackaging of that. So as an example, we work closely with Ondo, which is a sort of Web3 asset manager, again, regulated out of the US. What they do is they hold BIDL and effectively wrap it in a sort of cryptographic construct or in a smart contract, if you like, and reissue it as OUSG, which is accessible to the retail market, the international retail market. So you do get this repackaging. We're going to see more options available for the retail market, but the vast majority of funds is going to come from the institutional space.
Okay. Okay. Well, that brings us to our end of the set slides. So let's just see. Is there anything else in the chat box that we didn't go? So it was Alvin's question, which you've already addressed, Ross. So I'll just open the floor now, just for a few last minutes because we've gone past 8:30. But is there anything else that you would like to raise or ask Ross before we close up tonight? You're not only on mute, but you look mute. This will be recorded, and so we'll send it out if you want to take another look at it and think about things. Obviously, if you don't have a financial background, we've thrown just a whole bunch of stuff at you a lot in a short period of time. It probably takes some time to digest. So if you have any further questions, whether they're for Ross or for myself, you can send me the questions. I'll pass them on to Ross. I'll distribute the recording. We'll also publish the recording, um, Ross, through one or two other organizations I'm a part of as just sort of a general purpose things, like the local CFA society that I also belong to. Any last words before? I guess it's still early in the morning where you are, isn't it, Ross?
Yes, indeed. I'm in DC for company business. So yes, a bit early in the morning, not too early.
So let now that you've mentioned DC, let me ask you one final closing question. Because with this new industry, this new presidential administration, they seem to be very open to digital, crypto, and everything. So is this the sort of the 1987 big bang for crypto that we're seeing now? Is this when it all really takes off?
Well, we certainly hope so at Ripple, and obviously there's been a complete 180 in the regulatory stance and political positioning of crypto and digital assets and the broader blockchain industry in the US, and that has clearly made a huge difference. I think we've seen in the past that can mean a lot of non-robust businesses set up and these sort of pieces, but we're hoping it really paves the way to lean into the regulator and build out more closely aligned regulator services in the digital asset space. And that's what we're seeing so far. So I'm expecting a big pickup in this space across the industry. We're seeing many more opportunities to engage. The US is still by far and away the most significant investor market in the world. And I think we're seeing tremendous momentum going forward. So in short, yes. To answer Fiona's question, I don't think I'm not able to provide investment advice, but my recommendation is to, I guess, do your own research is the key. But yeah, obviously, I work in this space. I believe in this space. Beyond Ripple, I think the digital asset industry, particularly for trusted, reliable parties, will be very successful. And I'm certainly looking forward to the years ahead.
My early days of security markets were starting in about 84, just a couple of years before Big Bang. And the 15 years after that were incredibly exciting and intellectually interesting from a financial market development. And I get a sense that maybe you've just had your Big Bang. So it's behind me now, but it sounds like you may have some really exciting and good years ahead of you. So best of luck and thanks for taking this time, Ross. That's really appreciated.
Thanks, John, and thanks everyone for attending.
Okay.
Thank you very much.
So we'll send out the recording and have a good night, or in Ross's case, have a good breakfast. Cheers.